Hey everyone, today I'm going to be covering Zeta Global's Q1 2026 earnings. Today's video we have planned, we're going to go over some highlights of the quarter. I'm going to go through some notes I personally took. I went through and rewatched the conference call again, and I took some notes from important things I noticed from the CEO. And on top of that, as soon as we finish that, we will go ahead and go to my P&L analysis, and then I'll give y'all some closing thoughts and what I'm thinking with the stock going forward. So, also, if you're looking for more insight of what the company does or my bullish thesis and stuff like that, I'll go ahead and throw that up on the top right now. I did a whole video a few weeks back on what my thesis was with the company and why I thought it had such a strong moat, which it seems like that thesis is getting proven stronger, especially with the results in this quarter. So, with that being said, let's get on with the video. So, highlights of the quarter. First thing I want to highlight, 50% revenue growth came in really strong, beating expectations. This is the 19th straight quarter they've had a beat in raises. And the one thing right here, so even excluding the acquisition, they're still ahead of what expectations were. So excluding the acquisition of Marigold that took place, they were still at 29% organic revenue growth, not including the acquisition, which I like to see. And a good thing is they gave us a breakout of how much of this revenue growth was from existing customers and new customers, with 14% from existing customers, just expanding that average revenue per user, that ARPU. And then 15% of it was from entirely new customers they acquired within the period, which I like that they gave us that breakout. And that's really important to me because as great as it is to keep expanding wallet share from existing customers and getting revenue like that, at the end of the day, we need to see that their product is so good that other customers are starting to get pulled in and now they want to use it. And then the more customers we get, if we can get more funneled into the Zeta ecosystem, they will start spending more. So then we'll have that kind of that flywheel effect that the CEO always likes to talk about and they always like to bring up. But it's one thing for them to say it, and then for them to actually come through and delivering the numbers is great to see. So, next thing I want to cover, if we look here, the free cash flow was $42 million for the quarter, up 48%. So, really strong free cash flow growth. Very strong right there. Something I really like to see. We'll cover more on the free cash flow in a second, but this is one of the things when I look at that the value that makes the valuation so compelling, because right now I think the price to free cash flow is under 20, which is insane with the rate they're growing their free cash flow at. Now, next thing I want to touch on here is on this part, on the 9 out of the top 10 verticals that grew greater than 20%. And funny enough, they actually did touch on this on the conference call with one of the analysts asking a really good question on that one vertical that did not grow greater than 20%. They gave some clarity on that. That one vertical that didn't grow greater than 20% is less than 4% of revenue. So the vast majority of the revenue from the company, is coming from those 9 out of 10 verticals. All of those growing greater than 20%. Very exciting to see. Very great. Next thing up here. So the super scaled customers, growth of 19%. The average revenue per user growth of 21%. Now, this is insane because Zeta 2028, which is basically the company's metrics they have for what the growth rates they're shooting for by 2028, they were looking at 4 to 8% growth of actual customer count, CAGR 4 to 8%. And then I believe it was 12 to 16% on the actual ARPU growth for the super scaled customers on both of those. So 4 to 8% growth in super scaled customers. And then on the actual average revenue per user from those super scaled customers, they were looking around like the 16%. I forget the exact percent on that one. Ahead of both of their targets by a wide margin on this one. They went to, I believe it was 189. Yes, 189 super scaled customers this quarter. That's ahead of even last quarter, where they grew it by 5 sequentially, 19% year over year. Really strong numbers, really great to see. Super scaled customers, for anyone who's newer to the company and doesn't know what that is, that's just any customer spending more than $1 million with them a year. And actually right now, the average super scaled customer is spending $1.7 million with them, which is kind of insane to think about. And with that average getting so high, at a certain point, they're going to have to start breaking it out into even higher ones, like a hyperscale customer or something like that, whenever they eventually start hitting some customers that are starting to spend 5 million plus or something around there. Because I think they're going to get to that sooner rather than later, especially because of some commentary we'll get to later on that conference call that made it sound like they are starting to close some very large deals, which is very exciting as a shareholder to hear. So, next slide right here pretty much covered what I wanted to on this one. And again, these slides I pulled from the investor presentation. I didn't pull in all of them because I'm trying to give more of a recap, but these are some interesting ones that I just wanted to touch on and talk about. So just anyone who's looking for where I got these slides, it's the investor presentation on their website. Anyways, so we just touched on this. They're super scaled customers. So we can see a year ago, 159 to 189. That's that 19% growth we're talking about, which is really good to see. So they're scaling more of their customers that are spending more than $1 million, which is crazy. And then what's even crazier is this 1.7 million growing from 1.4 million a year ago. Very strong growth. And as they tend to take more and more of customers' marketing or their clients' marketing wallet share, I should say, this is just going to continue expanding. And again, like I was saying, that flywheel effect, more customers, the average customer is starting to spend more. This pushes up and up. This is what helps drive their revenue and their free cash flow just up and up over time. Now, some of you may notice or may point out and say, hey, why is it going 1.8 and now it's down sequentially from quarter 4 of 2025 to now Q1 2026? This is just simply just business fluctuations, because if you think about it, marketing spend is always heaviest for all companies. You'll see this across any advertising company. You'll hear it from Meta as well. Marketing spend always highest in Q4 of every year. Why? Because of holiday spend. Companies are going to tend to spend more on their marketing during holiday because that's when people are spending the most money. Q1 tends to be a softer quarter overall. So even with that, very strong numbers there. Very pleased with that one. Okay, and then right here, this is just covering more of what I was saying, where they are much ahead of that Zeta 2028 figure. So they were guiding 4 to 8%, year-over-year growth 19%. I'm not going to stick too long on this one because we already kind of covered that, and that's the same thing here. Okay, there's a number I was talking about. 12 to 16% was a modeled CAGR for the ARPU. For the super scaled customers, they are at 21%, which is looking great. And I think a lot of this is coming from Athena. If y'all remember me talking about in the prior video where I actually did the whole breakdown of my thesis, one of my main thesis points was that I thought Athena was going to be very similar to what AIP was for Palantir, in terms of the onboarding and just accelerating the usage. And it really looks like it is actually starting to take effect, and it is accelerating the company in a great way. So I am very pleased with that. Next one right here I wanted to touch on. So revenue growth, I believe, was 37%. I had this recalculated earlier, which I can quickly do this. So yes, 37% growth is what they are guiding for 27. Now, one thing I do want to point out here is at their current pace, they are likely going to beat these 2028 targets. Because if we're thinking, so they're at about a 37% growth rate on revenue, and it looks like they're only accelerating right now. So unless something drastic were to happen to the business, if we're thinking that they do hit that 1785 by 2026 and it continues to accelerate, or even they maintain the growth rate they have right now, we should be hitting this 2028 target by 2027, a whole year ahead of schedule, which would be insane to see. And yeah, this management team just does such a good job of just coming in and beating. They really know how to play the game of just come in under promise, over deliver. But the thing is, they still promise a decent amount. It's not like they are they're sandbagging numbers 100%, but it's not like the sandbag numbers are like, oh, that's not too impressive growth. You know what I mean? It's still very impressive if they hit these numbers and they still come in and beat and raise every single time, which is just great to see. We can see the revised numbers for full year. Originally, they're guiding for 35%. Now they're guiding 37. Don't be surprised if full year by the end of the year this raises even more, maybe to a 40% number is what the new revised guidance is by the next quarter, or even if they hit a 40%, just continue to outperform, especially with how it sounds like Athena's taking off. I'm pretty sure the Zeta Live conference. I need to double check the date on that because I do want to watch that Zeta Live conference, which I might cover that as well if I find anything interesting. But yeah, excited for that. I need to double check the date. But then we can also see Q2 guiding for 420 million of revenue, 36% growth. And now, so free cash flow. Free cash flow right now, if we head back over here, they are currently guiding for $235 million of free cash flow 2026. So just some rough math right now. The company's trading, last I checked, at about a $4.45 billion market cap. So $4.45 billion market cap divided by 235 million of free cash flow they're guiding for this year. Right now the company's trading at about an 18.9 roughly. Obviously the stock price is going to fluctuate and stuff, but currently right now they're looking at under a 20 price to free cash flow with these estimated 2026 numbers. Is that expensive? Not at all. Average companies you see with the free cash flow trading like maybe in that 15-20 range. But tell me the average company that's growing free cash flow like this. This is growing free cash flow in the 40% range. So do that 235. That's about a 42% is what they're guiding for in growth of free cash flow. So with some of these companies, because I will show you what my original projections were as well at the very end of this video, which I do need to update those. But sometimes you really do get these companies that can outperform and the valuation is so low that I'm not going to say the projections are useless, but it becomes less of an importance because you have no idea how much the company has so many growth vectors and so much potential to outperform that you really already have, and the valuation is so low that you really already have such a good margin of safety. It's not even that helpful to run projections because how do you even know the projections you're running, those percentage growth rates are even accurate because the company outperforms so heavily? Do I know exactly what the stock price is going to be by, let's say, 2030 or 2032? Do I know exactly what the revenue is going to be or the free cash flow? I have no clue, but I'd bet heavily it's a lot more than here. Like an extreme amount, especially when I'm paying an under 20 price to free cash flow for 40% free cash flow growth is kind of insane. Now, I believe that is the last slide I had on here. So we can kind of transition over and talk more about some things I noted on the earnings call. I took some notes on the earnings call that I wanted to highlight. So first thing I had noted was that the customers using multiple channels were up 50% and customers using 3 or more channels were up 40% year over year. Now this is important because customers using more channels typically have higher average revenue per user, which we're talking about earlier. That helps expand their revenue, build that organic revenue growth. Now, Athena has been driving more use cases, which is really good because right after that, the CEO followed up and let us know that the ARPU actually tends to increase 3 to 5 times greater when a customer is using more than one use case. So Athena is already having rapid adoption. Athena's driving more use cases, and more companies that are using Athena are tending to use more use cases with Zeta. And now, because of that, this is going to lead to higher of that ARPU growth. Next thing I had noted over here is the dilution, the company dilution. They're still in range for that 3 to 4%. I think they said right now they had 0.1% dilution. Don't quote me on that one. I should have written that one down. But they're still reaching their target about 3 to 4% each year. So they're keeping it in line. Good to see. And then also something even more important, they're talking about a new executive stock option plan for management, which I personally really enjoyed. So the way the new plan is structured to work is there are stock options, and so these the executives of the company are essentially locked in for 6 years with the company. If they leave within 6 years, those shares do not vest, so they don't get any equity. These shares are tied to performance based metrics. So let's say, like, okay, they have to make sure they achieve a growth rate of this, or maybe they have to get a free cash flow margin of this percent or higher to be able to get these shares, to be able to get rewarded these shares, rather than just, like a typical company where it's just like, oh, you've been here 2 years, we're going to reward you maybe like 1 million shares, and then also you have some options over here. No, with this one, the entire incentive plan going forward right now for these next 6 years is tied up in these options that only vest in management producing the results to make these options vest. So they have to hit those performance obligations. Like, for example, we don't know the exact specifics, but let's say, like, okay, we need you to have a CAGR over 25% for revenue, or 30% for the next 3-4 years. Something like that. Really like that. Really just aligns management with the shareholders, as well as they said they're not giving any equity besides this. So there's no other equity given to management besides for these options. I really think that's smart. It's aligning management with us, the shareholders. And yeah, I'm very happy with that. Next thing, they were currently talking about new clients that they've been acquiring, and this is really bullish. So a lot of the new clients are apparently much larger. They're already doing business with large enterprises, but apparently the clients they're doing, they have a much larger marketing spend budget, or yes, a marketing spend budget. So currently, from what they said on that call, the new clients' wallet size are 4 to 5 times greater than comparable ones. So they're still getting about the same percentage wallet share as they're getting of their previous customers, but that percent is on a bigger base. Instead of, like, if we're using small numbers, they're getting, like, let's say 5% of $1,000 marketing budget. Obviously, it wouldn't be that small, but just for simplicity's sake, now they're getting 5% of a company with a $5,000 budget, for example. And so that's really good because they're landing larger customers, which is just going to also increase their credibility, which they already have, obviously, but just in terms of sheer dollar value, that's going to be greater. But the fact that they still have the same wallet share means there's so much space for them to expand and take more wallet share. They even mentioned that their longer term clients currently are reaching 7 to 10% of their wallet share going to Zeta. So if we see that happening with these clients that are currently at 3 to 5 times the average marketing spend, that's just another growth lever for the company to pull and keep increasing these numbers over time. Now, those are the comments that I noticed that I found very interesting on the conference call. Of course, if anyone else also listened to the conference call and y'all saw anything else very interesting, or anything that you think is of importance, please throw that down in the comments, and I'll go back and look through the transcript and see if there's anything I personally missed that I could be looking at. Oh, one other thing that I almost forgot. So in that conference call, they did make it sound like they stole a client from a larger competitor. They didn't specify which, of course, but what we do know is that they did steal a client from a large competitor, a very large client, from what they're sounding like. They said retailer. From rumors I've heard, a lot of people are saying it may be Gap, like the clothing company, and it was a customer of both Adobe and CRM. But Not 100% sure on that. Don't quote me on that. But that's the rumors I've been hearing. Anyways, so go into the P&L analysis real quick, and then we'll go into my closing thoughts, as well as the valuation. So I usually keep these spreadsheets where I kind of just go through whatever earnings analysis and stuff like that. I keep them up on my tabs, but I already have the numbers imported right here from the most recent quarter. So we can see obviously the revenue up 50%, which I thought was good. Now cost of revenue was up higher, or cost of revenue was up higher than revenue, which I don't like to see, but there was also some color given on this on the conference call, with the CEO basically stating that a lot of the channels that a lot of these newer clients initially went into, they have a lower margin, or they have a higher cost of revenue side for it, but this is typically improves over time because of the added channels, and the customers typically spend more, which makes it basically makes the percentage of revenue should lower over time. I know I explained that, it's so bad, but essentially, as the customers are with them longer, the margins improve, is what I'm trying to say. And basically that initial social one that they have that has a higher cost of revenue and the worst margins, it's still accretive to adjusted EBITDA from what he's saying, and it's very sticky. So it's really just to kind of get them in, lock them into the ecosystem, and then they can start cross-selling them every one of their other products. So I'm still okay with that being the case. Now 36% on general administrative expense, and selling and marketing up 36, much less in revenue. I'm perfectly fine with that. Always like to see our expenses much lower than revenue, because if your expenses are lower than revenue and revenue is increasing at a more rapid pace, that's going to do great things for your margins, because revenue is always a larger line item. Now, research and development up 68%. So I highlighted this one yellow just because it is up higher than revenue, but I am okay with it, especially with how well Athena's doing. So yes, keep developing new products. Perfectly fine with me. Keep up the work on that. Depreciation was fine, less than revenue as well. Acquisition related and restructuring were pretty negligible, so not doing much here. So now we see operating expenses increase 48%, which is less than revenue. So we do like to see that there. Not a crazy improvement, but you know what? Over time, margins will continue to improve. And you can see the rest of them here. Not going to go too in-depth here, but we can see net loss was cut from 21.6 million to now down to 13.2 million. And they are currently guiding for 2 to 4 cents a gap profitability by the end of 2026, which is great to hear. They are turning profitable. Now, running over to this P&L analysis, again, this hasn't been updated since, I think Q3 of 2025 is when I last updated this, I'm pretty sure. But anyways, so I definitely need to do some updating on the numbers. If any of y'all want to look, these are kind of like the base bull, ultra bull case, price to EBITDA. Honestly, if I'm looking at, I have a price of sales down here as well that I was doing. Honestly, if I'm looking at this currently, sorry, I'm just trying to analyze. I think price to free cash flow would be what I'd likely base my projections on, in terms of which one I'm going to take the most comfort on. And Ultra Bull, think too high. I think Bull's more, this one has a higher likelihood. Base and Bull don't look too bad. I factored in 2.8% dilution, which I could probably bump that up for 4% just to be more conservative on it. So with my base and bull case, remember these numbers need to be updated. I need to take another look at this, but my original projections, I had a low fair value in the range 24.39, a high fair value in the range of 28.45. This was done when the stock price was at 18.58, by the way. And So this is basically saying if these assumptions were to occur, that 30% free cash flow growth, and the market were to give it a low price on the low end, price to free cash flow ratio of 24, and on the high end of 28, you would have to pay below these prices to get a minimum of 15% return, because that's the discount rate I used. And for the low stock price, we're looking at 49.05, and this is going out 5 years to 2030. High stock price of 57. The stock price is currently in the $18 to $19 range. So that's a CAGR of 21 to 25%, which is great. And if they exceed that, which wouldn't be surprised with how this company has been doing lately, if they were to exceed that growth rate, now we're talking 79 to 106. Again, I need to rerun these calculations over here, but just for anyone interested, you can go ahead and look at that. Also, I did have another video where I kind of went over how to build your own projection. So if you don't have this one, I just ran straight out of Stock Unlock, which is a software I tend to use to just speed up, because they have a built-in DCF calculator you can use. But sometimes I'll need to break out my own valuation models, or I need to be more specific, I guess I'd say, or I want to like segment it or something. So I do have another video, if you look back on the channel, where I kind of go over how to make your own valuation model on Excel, so you don't have to pay money for anything. Just build it yourself. It's not too difficult. Now, closing thoughts of it. I thought this was a smash out, like blowout quarter. All the numbers were really great. It seems like Athena's really catching on. And I feel like my thesis is not only more intact, but it's kind of strengthened. And my allocation to stock, in terms of like the proportion of my portfolio, was already fairly high. It was I have a lot of shares of this company already, so I was planning before earnings to start chilling out and starting to look for another position to start adding to, maybe focusing more on adding my SoFi, which is still a great deal. I might have to do a video on that, because that stock got hammered, but I don't think it deserved it. But anyways, after this call though, I'm now even more confident in the company, and I'm still going to continue buying. Even, I'll say today, I sold 5 stocks of ATI, or no, 3 shares of my ATI position, just so I could buy another like 20 something shares of Zeta. I'm blanking on the exact numbers I did earlier this morning, but yeah, I'm gonna continue my weekly buys. Zeta's gonna be in those weekly buys, and this remains one of the stocks I am very bullish on, and I am very excited for that Zeta Live. So that's going to be the video. I hope this one was much more helpful than the last one I made, and much more concise and easier to follow. And if y'all have any suggestions for any other earnings y'all want me to cover, or anything y'all want me to go break down, kind of like how I did here, please let me know. I can already personally tell you I'm going to be working on going through the Meta earnings. I'm going to go through the Amazon earnings. I still need to go through SoFi. And I think those are the main ones right now that I'm thinking of that I still need to go through. So I got a lot to catch up on, but I will see y'all in the next one, and hopefully I'll have those out not too long.